Welcome everyone to this quarterly update from Leithner Co. It's a slightly elongated update today because of what's going on in the markets thanks to Trump's tariff regime. Before we begin the details, please pause the video here to read the disclaimer at your own leisure. In this presentation today, we'll cover 4 areas. David will begin by looking at the long-term, medium-term, and short-term results of the company. He will also then dive into the asset allocation and the top 5 holdings as at 30 April 2025. Chris will then follow up with the actions and additions to our buy list since January of this year. And finally, I'll close proceedings with a discussion of how to contact us and show if you've got any interest in joining the investment company. David, over to you.
Thanks, Chris. Good to see you. It's an interesting result, the long term. Over the last 25 years, the results for the All Ordinaries Accumulation Index and our redeemable preference shares have been exactly the same. In fact, we've done 1 cent more, but we're happy to give the index the benefit of the doubt on that one. So we've both done about 8.2% compounded from December 1999 to December 2024. If you have a look at the way they're achieved, though, we're a lot more stable. So there's a lot less downdrafts there, particularly the GFC, COVID, stuff like that. We don't tend to lose as much. And that's an important thing, and we'll come to that in a couple of slides' time as to why that is. Shorter term, so we're talking basically the month before COVID really became a big thing. So January 2020 to April 2025, so the end of April, which in that period allowed for a little bit of the Trump effect to flow through. The Trump effect will take years, possibly decades to flow through, but we've got some idea of what's happening in the market at this point. So over that period of time, amazingly, but as Chris has told me, it's statistically improbable, but not impossible. Our short-term results are also equivalent to what the All Ords have done over that period of time. So basically 7% for us over that period of time and 7% for the All Ords accumulation as well. Again, though, if you look at the way in which we've achieved that, you'll see that massive drop in February 2020, which was when COVID really hit and the All Ords fell massively. Then recovered, then fell, then recovered. So if you have a look at us, we're certainly not a straight line. This isn't a term deposit. There is some variability of returns, but we're certainly a lot more consistent in our returns than the index is, but with a similar overall return profile over time, as we've seen, the exact profile, same over 5+ years and 25 years. So monthly for this period, so really short term, we're looking from January till April here. Interesting, about what we'd expect, but still good to see. So if you have a look at what we've done, January we underperformed. The market was still rallying in January. February, Trump did what he said he was going to do and introduced tariffs. The market mustn't have been believing him and fell pretty dramatically. We were up slightly. That was stock specific. So some of the things that we owned went up regardless of the fact that the overall market was falling. Similarly, in March, we were flat. The market was down. April was different. April, everyone got their animal spirits back and started buying things that possibly history will show they shouldn't have been buying. The markets rallied quite heavily, and a couple of those stock-specific things we mentioned went down a little bit. So we had a small negative for April. The stock-specific things are stuff like oil and gas. We have a reasonably large exposure to oil and gas, and in the short term, the oil price has fallen. So those companies have been hit as well. But we'll go through those in a moment. So this was the cumulative return for the period January to April. If you have a look, we in January both started at $1, and then we see what happens. The blue is the All Ords accumulation, so it got down to 92.8, somewhere around that mark from memory, 92.5. We fell down. Well, we haven't actually got down below $1. So again, just that consistency where we're not getting hit with quite as bad downside when the market does turn. A lot less volatility and a lot more stability of returns. Now, how do we achieve that? We're very conservative. So this is since 2000, so the last 25 years. This is our average cash balance. The mean is a touch over 50%. At the moment, we're a touch under 50%. So we're about normal. And that means exactly what it says on the can. We have a bit under 50% of our assets in cash, earning 4.5%, very stable, provides nice income for us, but it's not what we want to do longer term. We do want to buy shares that have higher returns, but it's a good place to sit until you find things. You're better off sitting in cash and buying things at good prices than spending the money just because you happen to have it and overpaying for things. In terms of the top 5 holdings, so our research on companies is very, very deep and very, very intense and takes a long period of time. So when we are ready to buy something, we tend to buy reasonably large portions of it. Origin at the moment is about 8% of assets. IFL is about 6%. APA is a touch under 6%. Telstra a touch under 5%, and Elders is about 4.5%. All of those companies have one thing particularly in common: they make lots of money, and we're not paying too much for the money they make. Some of them have some issues, have had some issues, and that's why we've been able to buy them. For instance, Elders, people tend not to appreciate that agricultural industries go in cycles. When we have a drought, Elders tends not to do too well, but you don't have droughts forever. There's been a few poems written about Australia to that effect. So we buy Elders when it's cheap, wait for it, and then the earnings eventually recover. APA owns gas pipelines, chucks off cash. Origin, lots of cash. So basically our modus operandi is to buy investments or companies that throw off lots of money and buy them when they're reasonably priced.
Thanks, David. Let's now turn to Chris to walk us through some of the actual and anticipated changes to the portfolio since January of this year. Chris, over to you.
Thanks, Chris. We're long-term investors, and since January, we've not sold any shares. We have, however, sold put options. That is, we've contracted to buy more shares over 2 companies, Santos and Woodside, whose shares we already own. We've also updated our research on BHP and Woolworths, and we'll write puts over them if their market prices fall to our buy prices.
There's been some important news over the past couple of weeks about Woodside.
Yes, that's right. On the 2nd of May, it announced its final investment decision, FID, on its $27 billion liquefied natural gas project in the US. Louisiana LNG, as it's called, will double Woodside's output of LNG to 24 million tons per annum by the early 2030s. And as a result, Woodside will become one of the world's largest producers and marketers of LNG. Globally, outside the state-owned companies in the Middle East, it'll rank number 2. Shell will be number 1, ExxonMobil number 3, and Chevron at number 4. Woodside estimates that Louisiana LNG has a payback period of 7 years and a lifespan of 40 or more years. Also, and crucially, Woodside foresees 40 years or more of strong demand for LNG, particularly in middle-income and developing nations. Apart from Louisiana LNG, Woodside possesses global scale and currently ranks among the world's top 20 producers of oil and gas. It also has a long history. It pioneered Australia's LNG industry. Since the 1980s, it's operated the Northwest Shelf Project, which is one of the largest resources projects in Australian history, and it possesses a long history of profitability. For these reasons and more, we think its future is bright. The Northwest Shelf project has reserves to 2070, and in an energy-hungry world, the consumption of LNG will rise for decades to come. As we've done for a quarter century, we're buying Woodside's shares from pessimists. If past is prologue, then at some point in the future, we'll sell them to optimists. In the meantime, we'll collect a steady stream of dividends.
Okay, Chris, why do we like BHP, and what's your recent research uncovered?
Okay, let's turn now to slide number 11. As you and most of our shareholders know, BHP is the world's leading, or among the world's top 2 to 3 producers of metallurgical coal, that is coking coal, copper, and iron ore. In about 18 months' time, in late 2026, it'll commence the production of potash in Canada, and by 2030, will be one of the world's major producers of potash. Since 2013, BHP's financial statements have enabled us to make direct comparisons among various attributes of its 3 main commodity outputs. Among the things which we've estimated are the break-even prices of BHP's production of these commodities. Break-even quantifies the point at which revenues per unit of output equal cash costs per unit of output. It marks the commodity price above which production is profitable and below which it isn't. The lower is the break-even price per unit of output, other things like commodity prices being equal, which they never are. The higher is the profit per unit of output. I've adjusted the 3 series of break-evens in the slide for the consumer price index and set them to a common origin, namely a base of 100 in 2013. The plot shows that 2 of these 3 commodities break-even prices, those of copper and iron ore, have fallen by about 11% in the case of copper and by a whopping 31% in the case of iron ore over the past decade. For each ton of output, in other words, BHP has become 10% and 30% more cost efficient. It's a different story for met coal. Its break-even has risen by about 40%. Fortunately, and perhaps for this reason, coal accounts for an ever-declining percentage of BHP's revenues. The third point in the slide summarizes the importance of these developments. Although BHP is to a significant extent a price taker in global commodity markets, it's generally been able to control and even reduce its costs. And as a result, it's also to some extent a margin maker. And a margin maker is eventually a profit maker.
And is there anything you'd like to add about Santos?
Okie doke. Well, let me add both with respect to Santos and Woodside, looking now at slide number 12. We've estimated their break-even prices, this time expressed in CPI-adjusted US dollars per barrel of oil equivalent. Through cost cutting and their transitions towards liquefied natural gas, over the past decade, their break-evens have halved, presently to about $20. Santos's cost cutting has been particularly remarkable. In a decade ago, or a bit more than a decade ago, in 2012, 2013, its break-even was much too high. Over the past several years, however, aided by the takeover of Oil Search and the jewel in its crown, the large and efficient PNG LNG project operated by Exxon, Santos's break-even has been slashed, and for the first time in years, it compares well to Woodside's. So, in conclusion, BHP, both Santos and Woodside are to significant extent price takers, but in recent years, they've trimmed and even slashed their costs, and to a significant extent are now are now margin makers. And margin makers, if things go reasonably well, are healthy profit makers.
Thanks, Chris. Just to summarize, we're in a very healthy position in terms of our cash at just under 50%. Other interesting metrics, currently the net tangible assets are 94.5 cents per redeemable preference share. Our market capitalization is approaching 35 million, and as we've announced on prior occasions, we intend to soft close at 100 million. If there's interest in investing in Leithner & Co, please consider contacting either David or Chris. We can arrange a Zoom in the first instance. We like to think of our investors as partners, not customers or clients. There's a minimum application of $500,000 for those, or for those that are interested. We will consider smaller amounts subject to discussions between the directors. Again, the contact information's on this slide, but also on our website at www.leithner.com.au. And thanks for your attention today. Thanks, everyone.
Thank you, Chris.
Thanks, Chris.